Investors Chronicle.
Hello and welcome to the IC Interviews. I'm Val Cipriani, Personal Finance Editor at Investors Chronicle, and today with me I have Stefan Gries, Manager of BlackRock Greater Europe. Hi Stefan, welcome. Thank you for coming on the podcast. How are you doing?
Good morning. I'm very well. Thank you very much for having me, Val.
Pleasure. So BlackRock Greater Europe is an investment trust with roughly 600 million in assets. It invests in European stocks with a quality growth approach, and the portfolio tends to be pretty concentrated. Currently includes about 34 stocks, with the top 10 holdings accounting for more than half of the total. So Stefan, maybe to kick us off, can you say a little bit about the strategy of the trust and what it is that it tries to do for investors?
Yeah, of course. Maybe starting with the investment objective. So the objective here is to deliver long-term growth in capital for our shareholders. And the way we look at this and the board looks at this, that ultimately we want to deliver an outcome that beats the benchmark, scores well relative to the peer group, but also delivers an attractive return in absolute terms. And we really aim to deliver those returns by taking less risk than your average investor. And we aim to do this by focusing on businesses with very healthy and dependable profit streams. Technically, so we look at our investable universe of over 2,000 companies in Europe. And then, as you say, we build a relatively concentrated, high conviction portfolio that ultimately consists of the 34 to 40 best opportunities that Europe has to offer. And really what we want to do is focus on what we think of as wealth creators, companies that can outperform the market on a sustainable basis. We often look for companies that have a real competitive advantage, that dominate their respective domains. And, in the past, I've sometimes spoken about a recipe for wealth creation. And we think of that as a combination of offering high returns, growth, and time. We really want to be an owner of businesses rather than a trader in stocks. And I think we've taken that approach because we believe that gives us the best chance to deliver on that objective of long-term growth and capital for shareholders.
So performance-wise, you've had 3 years or so that have been, in a sense, quite rocky. And then in the past year, there was a bit of a pretty decent recovery. Have you made any changes to your strategy or maybe repositioned the portfolio as a result? Or are you just, sticking to your guns?
Yeah, it's a good question. So first thing to say is we've just reported the financial year to the end of August. So the annual report has been released. And you're right, in the last year that has been reported, that the trust delivered a positive return of 15.5%, which we think is attractive. But it's also clear that that the last 3 years have been a little bit tricky. And we've always been quite clear to our shareholders that we believe that we can deliver the best results over the medium to longer term. There were some very strong periods in 2020 and 2021, and 2022 was a little bit more difficult. And ultimately, what the market is going through right now is, I think we're impacted by still a post-COVID normalization. We've seen a very long destocking cycle in the economy. And then more recently, also, China has been disappointing and it's been weaker. So from our perspective, we're going through a bit of a transition period. And to your question, we haven't really changed the philosophy. We're confident in that recipe for wealth creation I've mentioned. And where we do make portfolio changes, they're ultimately driven by single stock decisions. And the overview here is really that stock picking in a concentrated portfolio we believe can deliver attractive returns over the medium to longer term.
And on this note, so in terms of, the fact that you have not made changes to the strategy, something that I think will be of interest to our listeners is, how do you do that? How do you maintain discipline? Because when your style is maybe out of fashion or undergoing a difficult period, it must be tempting to try and do something different, perhaps.
Yeah. So just to be clear, we have not made changes to the philosophy. There's always some element of change, but that ultimately this is a very low turnover in a strategy, and we really want to be long term. But the second part to your question is really that for us it's always an evolution. So we start by building a lot of knowledge and expertise in a particular sector and stock. The company finds its way in the portfolio, but then we also think about it as keeping the plates spinning. So we keep going back to the same company, meeting them, 3-4 times a year, doing more work on the industry by speaking to experts, suppliers, and so on. And so the premise for me is always, when you go through a little bit of a transition period, you step back, you ask yourself the question, why were you there in the first place? And has your long-term thesis really changed? And what you find is that very often the answer to that is no. And I could give you lots of examples. But in many cases, we are aligning the portfolio to what we think of as very long-term income streams that are structural in nature and should persist for the next 5, 10, 15 years. And then intermittently, you sometimes get some periods of weakness, which is what we've seen in some of our holdings more recently. We hold the line, we build a lot of conviction in that long-term thesis, and we really only change if we see what we think of as a thesis break.
Yeah, I have quite a few questions around your portfolio and your kind of stock picking process. But let's maybe talk a little bit about the market first, because obviously, sentiment towards Europe has been since maybe 2022, fairly negative, with some periods where there has been more enthusiasm. What is your current view or outlook for the market? How are you feeling about it?
Yeah, I completely agree with you that sentiment on Europe has been weak, particularly so pretty much since the war in the Ukraine started. And we were seeing inflows into quite a few of our strategies in 2020, 2021, and then all of that pretty much reversed when the war started. Right now, actually, we see a pretty broad opportunity set. We're positive on the companies that we own. But one of the things we're quite clear to our shareholders about is really that don't confuse the European stock market with the European economy. We don't really have to be positive on Europe as a region to own a portfolio like this. We're active stock pickers. We focus again on our investment dollars on where we think there's some really compelling opportunities. And frankly, I don't really care whether Europe as a region grows 3%, 2%, or 1%, because a lot of our companies will deliver very attractive growth at high returns. And in that context, we often say, we are not really buying units of economic growth, and we buy units of earnings and cash flows in businesses that are extremely well positioned. And so, we look at the region as very much trying to focus on companies that offer core technologies, are enablers of some of the big transformations that we're seeing in the world. And they often come at much cheaper valuations than their global peers and US peers in particular. We know that asset allocators remain quite heavily underweight our region. And I think for the sentiment to change, it doesn't actually take so very much from here. I could give you 2 or 3 points that very quickly could change the view on Europe. And if you think about elections in Germany coming early next year, I think that's quite important, because Germany has been quite a drag on growth, and we're expecting change there. We know that there's potentially prospect of the Ukraine war coming to an end. Again, that would be quite a positive for the region. And then lastly, China obviously has been weak. It's an important export market for Europe. And again, we've seen quite a few measures there now that hopefully should start to stabilize the economy and bring a better 2025.
What about the result of the US election? Because obviously the one big topic of conversation is that Trump is expected to impose a lot more tariffs on European goods. Will the companies in your portfolio suffer as a result?
Yeah, no, it's interesting. And actually, I was lucky enough. I was in New York with my colleagues in the US on the day of the election. So it was fascinating to just observe what was going on. As you've seen, and most of the listeners will know, the initial response to the election has obviously been quite positive for markets. It's also been a positive for our portfolios. We own a lot of US dollar earners, and then also again beneficiaries of some of the large areas where spending is going to come through: infrastructure, reshoring, data centers, and so on. What we are watching from here is, in the near term, the appointments into some of the key roles, because that will give us a good view on what potential policies could look like. There's no doubt in my mind we'll see some volatility along the way. There'll be some headlines that will scare people. From our perspective, initial policy priorities likely to center around trade, immigration, and again, potentially the war in the Ukraine. But if we step back and if you think about what Trump ultimately won the election on, it was cost of living and inflation and immigration. And so some of the things that have been discussed in the past, like introducing tariffs, wholesale, across the board, and cutting immigration, they are actually inflationary in nature. And so it'll be interesting to see how far and how aggressive they go. Like one of the maybe final observation, when you're there and you're immersing yourself kind of in the US environment, it's just very clear how the US is setting the pace when it comes to some of these big topics, AI, infrastructure, investment, and it's really, I think, putting pressure on the rest of the world, including Europe, to act. It could be a bit of a wake-up call for Europe, and that's something we're monitoring very, very closely from here.
And so I guess given all those different things that we talked about, how bullish or bearish are you feeling? And maybe you could touch on your approach to gearing as well, because it's usually a good indication of how a manager feels towards their market and their portfolio.
So, I mean, on our market, it's what's very clear is that we started this year expecting to see more evidence of recovery and economic momentum to come through in the second half. And clearly that has been delayed and the recovery has been shifted to the right. But we remain constructive and the portfolio is constructively positioned. And, again, like we have a large and very well-resourced team. And when we talk about the macro view, it's coming from the bottom up. Like our team, we do about 2,500 company meetings per year. We did, 300 just in September alone as a bit of a reality check. And what is clear is that some of the sectors, what we think of as old economy sectors, had already been under pressure for 2 or 3 years. Think about Northern European residential construction, and there's other examples like chemicals. And we think that they are going to start stabilizing as we move into 2025, while the structural spend and the structural areas continue to come through at a time when interest rates are coming down and inflation has been easing. And so we think the investment outlook for next year is a lot better. We also observe that valuation of European equities is probably at the widest discount we have seen. So it's 35-40% relative to the US. I said already, asset allocators are underweight. So we also know there's a huge amount of money sitting in money market funds at the moment, anywhere between 17 to 19 trillion. As rates come down, again, some of that will have to find a new home. And so we actually think the outlook is constructive on that basis. And, to the question on gearing, we are the first to say that we never try to time the market. The use of the gearing is really kind of an organic process for us. It's a natural reflection of the opportunity set and kind of where we see opportunities to deploy capital. It's clearly one of the attractive tools you have within the investment trust universe, that you can just do that little bit more to magnify returns. And so right now the trust is geared 8.5%, 9%. And I think that's a direct reflection of the opportunities we're seeing in the market.
Right, of course. Let's move on maybe to talking about the portfolio. How do you pick your stocks? So you look for Europe's highest quality, fastest growing companies, irrespective of their size and geography. So you've touched on this a bit at the beginning, but what features do you look for? What metrics do you focus on to find these companies?
So the first thing to say is I feel quite lucky because we, obviously, there's a lot to look at. There's a large opportunity set to look at. I already said over 2,000 kind of listed companies. And, we have a really well-resourced team. And ultimately, we want to find really strong ideas, as you mentioned. But we're also very honest about the fact that when you look at that universe, it's quite heterogeneous. And, there are parts that we believe don't lend themselves, certain industries and sectors, to wealth creation on a duration basis. And so we think it's really important that you are quite clear about what it is you're looking for. And I always start by asking the question, when we look at a new idea, can I own this asset for the next 3 to 5 years, and why? Because also 5 times a year, I have to sit in front of the board and explain any changes I make to the portfolio, and I need to be able to articulate, right, we've just found this new idea, I think it's great, these are the reasons why it's going to be in the portfolio for a really long time. So that's the first question. Second question is then I ask, I want to think about the end market and the industry that a company actually sits within, and why that industry is a good industry to create value over time. Then we come to kind of our criteria. It's kind of four things we're really looking for. We want to invest in businesses where we can trust the management team, where they have a clearly articulated strategy for value creation, where they instill the right culture in the organization. We're really big on that because we've seen over time that culture really is important to create value. We like businesses with a high return on capital employed, and again, a management team being able to explain what the incremental return is that they're getting on projects they're investing in. We like businesses that generate a lot of free cash flow, because that cash ultimately gives them the opportunity to invest in attractive growth projects at high returns. And so all of this actually leads to one thing, is that we think that what you need for shares to do well over time is for the business to earn a healthy return over its cost of capital and to have some opportunities to grow. And actually, when we bring all of that together, we often end up owning what we think of as global leaders that are listed in Europe, companies that are dominating their respective segments, that have pricing power. I mean, sometimes call them giants in niches. And as I said earlier, while Europe often gets a lot of bad press, when you look at some of these companies, they really do have some of the core technologies that are needed for some of the big transformations that are going on around us. And that makes us feel, very good about the portfolio overall.
Let's maybe talk about some of these companies. So the two top companies in your portfolio are Novo Nordisk and ASML. They're also the top companies in the index, but you are definitely overweight on both, and they account for about 7% of the portfolio each. So it's quite significant positions, and they both have had a bit of a tough time recently. Maybe starting with Novo, which has had a couple of years of obviously very strong growth and then came down more recently. Do you consider the sort of coming down of the price an opportunity, perhaps even to maybe top up the position, or are you feeling more cautious about the company right now?
That's a really good question, and I think your point is absolutely right. This has been a really strong performer. And actually, ultimately, having an intermittent share price setback is a healthy development in our view. Now, maybe for those people who don't know the companies, so Novo Nordisk is a global leader in diabetes care and is also a provider of obesity drug one called Wegovy, which is a market that's really quite attractive. And what we like about this investment case is that Novo operates in a duopoly, a two-player market with Eli Lilly, and both of these companies have basically been sold out over the last 2 years, being producing at capacity, just because demand was so much stronger than the supply they could deliver for obesity drugs in particular. And one of the things we've observed is both of these companies have been very careful in the way they're serving this demand for obesity drugs, because they want to make sure that any new patients coming onto drugs can stay on those drugs. And when we step back again, we are in the early innings here. This market is still in its infancy. In 2023, the entire market was worth about $6.2 billion. At that time, Novo was the only seller, and the market itself is forecasted to grow to up to $130 billion by 2030, and should eventually peak closer to $150 billion. So you can see the growth potential there is really quite significant. It's even if it doesn't stay a two-player market, any growth here will come at very high returns, and we think Novo's market share eventually will probably settle at around 40%. The bit that's sometimes overlooked, and that's maybe the last point, is that everyone just focuses on the US. There's about 100 million potential patients there, but we also think that the opportunity outside of the US market is almost equally as large. And what you're likely to get is 15 to 20% sales growth, higher earnings growth for the foreseeable future. And when we look at the valuation, Novo Nordisk trading on 20.5 times 2026. And that main peer I was talking about, Eli Lilly, is trading at 27 times in the same year. So we actually think this screens very attractively, which is why it stays one of the largest weight in the fund, basically.
Is the Novo story now all about those drugs, or could there be other opportunities coming up? Is there are there other things happening at the company, basically?
There is always evolution of the portfolio, and so you'll get follow-on drugs that we're actually waiting for an important update in 3 or 4 weeks, which will be follow-on drug called CagriSema to the existing drugs. And that, again, when they come through positively, they extend the duration and the lifespan of the growth. And this is an R&D powerhouse. So there'll be iterations and new innovations coming out of Novo, for certain. They also have done historically small bolt-on acquisitions, but first and foremost, it's about the longevity of the growth, the fact that it'll be really hard for them with that growth to keep their returns and margins low. And I think that's the bit that the market is probably underestimating. This company has the cleanest accounting of any healthcare company in Europe. It throws off a lot of cash, and they typically return that as well via share buyback. So it's quite a compelling investment thesis overall.
The other company I wanted to ask you about, it's ASML. So ASML shares dropped about 20% last month after the company reported a drop in its bookings and sales forecasts for 2025. Was this a surprise? Was this a disappointment? How are you feeling about the business right now?
Yeah, I mean, it was a surprise. We didn't expect this to happen. And I mean, there's a few bits here. So firstly, I guess, again, for those people who maybe don't know the company, so this is a leading provider of lithography tools, and those tools are used by the leading semiconductor chip manufacturers to produce those high-end chips that are used in many different applications, whether it's electric vehicles, data centers, artificial intelligence, lots and lots. And then, as you rightly say, Val, the disappointment with the Q3 results really was about the outlook for next year, for 2025, where they lowered the revenue range for that year, which led to some earnings cuts. It was largely caused by 2 of its major clients announcing delays to their orders. So this is one key US foundry company, and they just pushed out their order. And this is all about node migrations. So you go smaller and smaller in terms of the chips. They become more powerful, and that US client decided to skip one of the nodes, which meant they were ordering less tools. Then there was another large Korean client, struggling to win new design work from some of the leading customers. And so ultimately, we think that those orders are delayed and not lost. And the reason why we think that is that, given some of, again, the big technology transformations that are going on around us, the world can simply not rely on just one foundry based in Taiwan to produce all the high-end semiconductor chips that are needed. And, we don't really know what any given quarter looks like, but we actually do think that 2025 estimates for ASML are now largely de-risked. We think they found a relatively conservative base, and the valuation has come down as well. And actually, this is one of those situations where, again, you want to step back. And when you look at that artificial intelligence value chain, there are many different components and process steps that are needed to make this work. And I guess our observation is that in every single one of those steps, you have 2, 3, or 4 different suppliers. There's only one supplier in lithography, and that's ASML. And when we talk about lithography, if you want to bring this to life, those machines require a level of precision that's comparable to firing a laser at the sky and then hitting a golf ball size object on the moon. So really very complex. And ultimately, you could argue that to some extent, the AI revolution hinges on this one company, which is ASML. So we don't find very many listed monopolies in Europe. This is one of them. And we stay invested because we think the medium to longer term outlook remains quite compelling. Just last comment, they actually do have their capital markets day today, and they've reiterated their 2030 growth ambitions, which has been taken quite well by the market as well.
So you were mentioning Taiwan and, well, TSMC basically. So with Trump winning the US election and potentially the risk that the trade tensions between China and the US will, heat up a bit, is that a risk for ASML? Because it's obviously quite a big thing for semiconductors in general.
Yeah, and again, I'm sure it'll lead to headlines and some volatility, but then you have to really think of it from different perspectives. So firstly, restrictions on exports is bipartisan in the US, and it's kind of been a recurring and an ongoing discussions. And again, we take our learnings there from conversations with ASML as well. We would note that I think two important counter arguments to going really very hostile is that you also have a company in the US that produces most of the smartphones used in the world, and they still have 75 to 80% of their production in China. And so if you impose, very tough tariffs or restrictions on exports, that's the easiest way for China to fight back. And again, that is potentially a source of inflation for US consumers. So that's, I guess, one point. The other point is that if you remember what happened during COVID and when we came out of COVID, there was a massive shortage of semiconductor chips. There was as a result, you couldn't get the cars you wanted to buy or had to wait for a long time. There was, shortage of even chips going into washing machines and some of what we think of as lagging edge technologies. Now, China has built up 25 to 30% of lagging edge chip manufacturing capacity globally. And again, if you go too hostile, you're basically creating issues for your car manufacturers, for your white goods manufacturers, any supplier that is reliant on those. And so I think it has to be balanced, and we'll be monitoring this very, very closely. For what it's worth, the companies themselves were slightly more optimistic on what is to come. But, as we all know, it's a little bit unpredictable at this stage.
Yeah, of course, a bit early to tell as well. The other sort of big conversation around semiconductors is obviously, what will happen with AI. In your annual report, you wrote that some of the initial excitement was clearly overdone. Well, obviously, still a very big thing. Can you say a bit more, about how you feel about AI as an opportunity and then maybe even as a risk for certain companies?
Yeah, so I guess the other point we made in the annual report was actually that when we look at adoption of new technologies, they often follow a very similar pattern where people overestimate what can be done in the near term, but we tend to underestimate the impact over the medium to longer term. And that's kind of the sentiment that we think is right for this situation. But it's also fair to say that I don't think in our investment careers we've ever seen capital deployed at such scale and pace, and that capital and that investment is percolating across many different industries and beneficial to many different companies, whether it's semis, companies servicing power infrastructure, data centers, and so on. And so from our perspective, first and foremost, it's really a race for infrastructure build out, the need to meet energy demands, have those sources of power in the right locations, all with the aim to produce the most powerful compute. So it's all about scale. It's about a process that's feeding on itself, because once you've got all of that in place, it's all about developing, again, the most powerful chips that then allow you to have the best models, and those models then help you to, again, design the next generation of chips. And so that's why the US is in a very good position right now. But ultimately, our jobs as active stock pickers is to identify the winners and losers in this race. And generally, what we like to do is own the companies that provide the picks and shovels. And the good news here really is that Europe, again, as I've already mentioned, has quite a lot of companies that are offering core technologies that are enabling, some of these developments, beneficiaries of, this very large amount of money being spent by the hyperscalers in particular. And, those opportunities for us, again, in areas like semiconductor equipment, but also in some of the industrial and building material names. Now, for instance, just to give you a little anecdote, we spoke to one of Europe's largest cement company. They're really transforming themselves. A lot of the cement is becoming low carbon green cement. They were talking about one of those very large US hyperscalers building a data center in the US and basically saying the only way you win a job like this today is if you can show that the cement that's going into that new building is low carbon and green in nature, because that company itself has to report on emissions again as well, which I thought was really quite interesting. So, we actually think that ultimately it's fair to say that the AI revolution wouldn't really be possible to happen without a lot of the input of European companies, or at least it wouldn't happen as fast. And longer term, I think it'd be really fascinating to see, to come back to where we started, how it spurs productivity gains across the economies. And that's something we'll be monitoring very, very closely.
So semiconductors are also very cyclical businesses, of course. And you do also have a good chunk, about a fifth of the portfolio, in consumer discretionary. Is more generally like cyclicality something you worry about? Is it a concern, or maybe not so much?
Well, I guess, again, we want to make sure that the businesses are supported by healthy spending streams, sustainable income streams over the medium to longer term. But to be clear, is that we would only really, so we want to be owners of businesses for the medium to longer term. We wouldn't sell a company because we thought the next quarter or two are going to be weaker. What we sometimes do is, like, if we look at what we think of as a bit of a transition period, we might lower the weight, but we're very unlikely to exit a position on that basis. And actually that approach has worked really well for us, over the last 7-8 years. Taking a longer term approach, being really patient, and again, giving the companies and the management teams the time to execute on the strategy that they've laid out. I think that's where a lot of the market often takes a bit of a too short-term an approach, and we want to be different from that.
We have spoken a little bit about China in terms of impact on semiconductors. It is also an important market for some other of your stocks, such as the luxury stocks such as LVMH. What's your view there? Because obviously, as you were saying, the region seems to have disappointed a bit compared to what was expected in terms of recovery post-COVID, really.
Yeah, I mean, it's a big topic. And if we're honest, the Chinese economy right now is probably the weakest we've seen it in the last 15 to 20 years. And there might be an element that they haven't actually had to deal with a crisis like this on that scale. But having said that, we do expect things to stabilize near term, and for there to be a bit of a recovery as we move into 2025. We've seen a number of measures now from the government, and there's likely more to come. You asked me about the US election earlier, and actually one of the things that's obvious to us is that China is probably going to wait a little bit to see what's coming in terms of rhetoric from the US before they announce more measures. So that's something to consider. But I went to China in 2011. We went there on a research trip, and we saw lots of different companies and went into car dealerships and spoke to property development developers and so on. And I remember at the time we asked the question to some of the locals: what happens if house prices start to fall? And I remember they looked at us almost in disbelief and just said, no, this can never happen. And I think that's really one of the key problems right now, that Chinese households hold up to 70% of household wealth in the property market. and property prices have now corrected by 25-30% from the peak. And that's really what's led to big hit in confidence and consumers prioritizing savings over spend. So whatever the government does from here, the real estate market and residential real estate has to be at the center of whatever they do, and they need to try and stabilize that market. Now, on the positive side, despite what I've just said, actually, we do look at numbers very, very carefully, and what you can see is that there is still wealth creation happening. There's still a large number of people moving into that affluent middle class. There's some estimates we have seen also on the high net worth cohort growing by over 40% into the end of the decade. And it's that cohort that's ultimately really important to the European consumer goods companies and luxury goods in particular. That's where they recruit new consumers and win new customers to the brands. And that's why, again, we are prepared to take a longer term view here on some of our key holdings in the sector.
Bit of a shift in geography, but can I ask you about the UK market? So it's not in your benchmark, but you have quite a sizable actually allocation to RELX. So I was wondering, if you find generally opportunities in the market, how do you feel about it, and whether you could maybe be tempted by other UK stocks at some point?
Yeah, so I mean, as you rightly say, the trust universe is Europe excluding the UK. So we don't tend to invest in UK equities in this investment trust. RELX is one exception, and it's really for historic reasons, because the company used to run a dual headquarter structure, and they had a main office both in the UK and in Holland. And that structure was then simplified in 2018, and they moved to a single parent company based only in the UK. So that's where our position in RELX originated from. We've held it for a long time. We actually think of it as one of the highest quality defensives you can find in the market. You always want in your portfolio construction to have an element of defensiveness. We call it the defensive bucket, and RELX is one of the star companies in that bucket. We really like it because it's a subscription-based business model, mainly lots of recurring revenues, giving you a great amount of visibility on where earnings and cash flows are going. And they've invested a lot. They've got state-of-the-art analytics and decision tools. It's basically one of the few companies right now you can point to that are already monetizing AI. So AI and training models is about having the right and large amounts of data. And this company has lots and lots of data and has already started to incorporate AI tools into their various different products. And as a result, we've seen a step change in growth, and growth really stepping up. So we like that investment case. And I guess on the UK more generally, I guess we have some strategies on the team that invest in the UK, and the market generally remains cheap. We think there's some great opportunities in the UK market for active investors that are willing to do the work. And so there's definitely some opportunities to be harvested.
Can I ask you about that group of stocks that are sometimes referred to as the granola stocks? There's a lot of conversation about how they've been driving returns for the European markets in the last few years. Is that something you even think about? Because it's, of course, like quite a random collection of stocks in a way.
Yeah. We don't tend to pay too much attention to it, if I'm honest. I mean, I think there were some smart investment banks that thought they needed to come up with an equivalent to the Magnificent Seven in the US. And so, and actually, if I'm honest, if I look at the different constituents of that European equivalent of the granola stocks, I just think that there are some companies in our portfolio that are so much better than what those companies kind of represent. And so I think we can do a lot better by picking what we think are the long-term winners. And then what we want to do is kind of when we identify those winning franchises that are listed in Europe, we want to size them large, and we want to run them and let the value creation happen over time. And so that's why we don't pay too much attention to it. But ultimately, these things get created because you can form baskets, and on baskets you can earn fees, and it might create some turnover as well. But I think the concept emerged and then died relatively quickly again because it didn't get the attention that people were hoping for.
Yeah, no, that makes sense. For the listeners, I should say that, there are a group of like 11 stocks. They include some we've already discussed, like ASML, Novo, LVMH, and then also a bunch of others like Nestlé, SAP, Roche. Yeah, quite a big group of stocks that don't necessarily have loads in common, perhaps, aside from having had a good run in the last few years.
You can now get 12 weeks of an Investors Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
Another thing I wanted to ask you about was emerging European market. So you are allowed to invest them in the trust, but correct me if I'm wrong, you don't seem to be investing in them right now. So we're talking countries like Poland, Turkey, Greece, and so on. Are you tempted at all, or what would it take for you to find interesting opportunities there?
Yeah, so you're right that it's still part of the remit, but we have de-emphasized that part of the remit a bit over recent years. So we used to have a slightly different setup on the trust, where my co-manager was the head of the emerging European team at BlackRock, and we made a change there, and we brought on a new co-manager, Alexandra Dagur. She's a member of the European team. And I guess the most important thing to understand for our listeners is that, with Russia moving out of that opportunity set, there's a lot less to go after. Equally, we look at everything. And so if we were to find a really compelling opportunity in Poland or in some of these other markets, because we do have that depth in terms of the research, we would definitely consider it. But right now, we find more compelling opportunities, closer to home in I guess the developed European markets. Maybe the last point on this, that that segment, emerging Europe, historically has also been a lot more volatile. So it's just a different beast, I would say, in terms of how it trades, how shares behave. And so, the threshold for us to put some of these ideas in is probably slightly higher, because there's a lot more you have to consider. You often have to consider currencies. You have to consider the political environment in the country, much more so than you'd have to do by investing in a company listed in Holland or in France or in Germany, for that matter.
Final question. In terms of opportunities, is there, any sector in particular, any area in particular that you think is looking especially promising right now, where you're finding more ground to look for interesting stocks?
Yeah. So there's a couple. So again, we actually think the opportunity set is really quite attractive. It's also quite broad. So, if I think about some of the larger exposures that maybe we haven't talked about so far, it's definitely European building materials and construction names. So that's an interesting segment. So there's different parts to this. So within construction, you have like renovation, and that market has actually been fairly resilient, but we still see that as strong going forward. Infrastructure is a market that we like, just so much investment having to happen both in Europe as well as in the US and other markets. But the area that has been weak, where we are expecting recovery to come through, is residential construction. And again, some of our holdings will benefit from that. It's firstly helped by lower mortgage rates and financing costs. And then secondly, and most importantly, we all know there is a structural shortage of housing, not just in the UK, but also in important markets like France and Germany. And so there's potentially a lot of pent-up demand. And interestingly, some of the companies are now talking about seeing stabilization and recovery coming through. So that's an area. We've also added recently to private market operators. So, these are companies, again, that are benefiting from financing condition easing, the general environment for transactions becoming better as well. So they'll be earning performance fees as and when assets are being sold, and then fundraising environment also better. And the valuations here have been screening quite positively as well. And then maybe slightly differently to some of our all-out growth peers, we actually think that the market is underestimating the resilience in earnings in European banks. So this is a sector that people love to hate. So we've obviously seen a period post-financial crisis where it was quite painful to be an owner of European banks, and we didn't. But again, this is from our perspective, the names we own here are operating in consolidated banking markets. The capital positions have become really strong. The economy is actually doing better already than the rest of Europe, and there's huge potential for shareholder returns. And the reasons why they're still trading at really depressed valuations, 6-7 times earnings, is because nobody believes in the sustainability of the earnings and the returns. And that's the bit we think the market is getting wrong, because we actually think that they'll have much more duration, and we're being paid to wait. So the names we own returning 15% of their market cap every year for the next 3 via share buybacks and dividends. And to us, that's quite attractive.
Stefan, thank you so much. This was a really interesting conversation, and I'm sure our listeners will have found it so as well. I'm afraid this is all we have time for today. Thank you very much for coming on the podcast. Thank you to our producer, Maddie Athorpe, and thank you all for listening.